Well, hello, everyone, and welcome to the launch event to celebrate BlueMark's third annual Making the Mark report on best practices in impact management. Before we get started, I'd like to share a few quick details about today's event. We're going to start by sharing a few of our key findings from the Making the Mark report. And then we will have a half-hour panel discussion with our featured speakers who represent leading impact investors and industry experts. We're going to save about 15 minutes for audience Q&A, and please do use the Q&A function, and we'll try and get through as many of your questions as possible. The report itself is going to be formally published tomorrow, so we are excited today to share a sneak peek or a sneak preview with all of you on this webinar. A member of our team will put in the chat a link where you can download the full report in a moment. So back to Making the Mark, which features data and insights from our first 60 verifications of impact investors who manage a combined 160 billion in impact assets under management. This is double our sample size from last year's report and reflects the growing demand for impact verification in the market and the growing desire to align with best practice in the market. Accordingly, the theme for this year's report is spotlighting leadership in impact management. We chose that theme because we saw an opportunity to use BlueMark's verification method to highlight those impact investors that go above and beyond with their impact management practices. To that end, we're excited to share that this year's report features the inaugural introduction of the BlueMark Practice Leaderboard, which highlights those BlueMark clients that scored in the top quartile of impact management practices according to our method, which is grounded in the operating principles for impact management, or the impact principles for short. So our congratulations to the 5 impact investors named to the inaugural leaderboard. And those 5 include Bain Capital, Double Impact, Finance in Motion, Leapfrog Investments, Nuveen Private Equity Global Impact, and Trill Impact. It's our hope and ambition that by shining a spotlight on a handful of leaders, we can encourage a race to the top as more impact investors learn about and eventually embrace best practices. I personally strongly believe that one of the best ways to address our sustainability challenges through the use of investment capital is to encourage this race to the top. Ever more competition and innovation around impact management practice and performance results. And ultimately, that kind of optimization will help to achieve stronger and ever increasing social and environmental impact and outcomes. It is this belief that why we launched BlueMark in January 2020 and made the commitment to continuously share our findings with the market to help practitioners understand the speed and direction of travel across a range of impact investing strategies and practices. Our annual Making the Mark report is a reflection of that commitment. With that, I'll hand it over to Tristan Hackett, director at BlueMark, who is the primary author of this year's Making the Mark report, and he will share with us some of the key highlights in this year's report. Over to you, Tristan.
Thanks, Christina. And I think there may be a couple slides to share here just as we discuss the key findings. But as Christina alluded to in this year's 2022 report, we did double our sample size from last year to now 60 distinct practice verifications across a diverse set of investor types and asset classes. And if you go to the next slide, this is represented in the benchmark graphic that we have displayed here. So the principal or impact management practices on the left-hand side and the aggregated set of their corresponding ratings from low, moderate, high, and advanced on the right. And what we found in our updated 2022 benchmark here is that the increased sample size really reinforced some of the trends that we were seeing in our earlier Making the Mark reports, particularly that investors tend to integrate stronger impact management practices at the earlier stage of the investment process and struggle more at the latter stages. So that's represented by the increase in low and moderate scores shown in orange and green towards the bottom of the chart here. And similarly, the median set of scores represented by that middle line on the graph also remain the same as the 2021, which for us really underscores the current benchmark for the state of impact management practice. That being said, there were several notable shifts in the spread of underlying ratings across these areas, which we analyze in some detail in the report. And I'll just share a couple examples here. Firstly, the share of advanced and high scores increased notably in two areas. First, assessing investor contribution, which is part of Principle 3. And similarly, managing and assessing sustainability of impact at exit also increased Principle 7. So two previously more overlooked or niche practices in the market we're starting to see more established practice around and beginning to enter the mainstream of impact investing 3 years after the introduction of the impact principles. But on the other hand, there were other areas where the share of high and advanced ratings trended downwards. This was particularly true for the first two principles, the strategic intent ones around establishing impact objectives and strategy and portfolio level impact management. And one factor here that we share more about in the report is how at BlueMark we continue to evolve our scoring criteria and methodology as the impact investing industry itself evolves and matures. So for some of the historically well-scoring areas with well-established practice, we do try to raise the bar to stay dynamic. So for an example here on setting impact objectives, we added criteria this year on what qualifies as a really evidence-based, robust theory of change based on our observation on the state of practice. So these changes, in addition to the high precedent set for those areas, likely a factor in some of the shift in ratings there. Another key component that I just want to discuss quickly as well is sort of the analysis of impact management practices that are underlying these overarching areas of practices. And if we want to go to the next slide, I'll just call out a couple of key ones that I'd like to touch on. The first is related to staff incentive systems linked to impact performance. And what we found here is that despite a increasing discussion around impact linked incentives in the market, it still remains a relatively limited practice from our data. We found only about 38% of the impact management systems that we verified to date explicitly integrate an impact performance linked to staff incentive systems, which is actually a decrease in percentage from last year's sample. And if we look at that number a little more closely, we see that only 20% of the systems have an explicit financial incentive mechanism, such as an annual bonus or impact link carry linked to impact performance. So although a super important topic, our data suggests still have a ways to go to figure out how to really embed impact management as a fundamental practice. And I think another related practice that I'd like to touch on is that of setting impact targets. And what we found here in our analysis is that although the majority of our clients at 63% established some sort of expectation around impact before monitoring, such as a baseline KPI or a qualitative rating or a composite score, there is a wide variety in the consistency and quality of target setting across different themes and assets. And I think it's this variance in setting targets that makes it really quite challenging to implement other key practices, such as that staff incentive link or impact underperformance protocols, for example, where it's really important to have clarity on what under or overachievement from an impact perspective looks like in order to incorporate. So impact target setting a really challenging but fundamental practice that enables some of these other impact management practices, and we continue to see sort of mixed results around there. And then just lastly, a practice that we're encouraged to see a lot more discussion and implementation around is engaging and stakeholders in the impact management process and incorporating their voice into impact monitoring results. I won't go into too much detail there because I believe we'll cover this in a bit more detail with some of our panelists later on, but excited to touch on that topic. I think I'll leave it at that for now in terms of some of the headline findings, but really hope you enjoy the detailed analysis in the report and dig in and find some practical insights to inform your own impact investing practice. And with that, back over to you, Christina, to introduce the panelists.
Great. Thanks a lot, Tristan. Clearly some notable improvements in practice in the market, but a long way to go for the field as a whole. Well, I'd like to introduce our esteemed panel now and move into the discussion part of our agenda. So first, I'll start by introducing Daniel Brandão, who is an impact director at Vox Capital, one of the few pure play impact managers in Brazil. We're also joined by Pia Irell, impact partner at Trill Impact, a relatively new player on the block, but a large one and a member of our practice leaderboard. Pete Murphy, Director of Private Equity Impact at Nuveen, and Luyen Tran, Chief Development Impact Officer at the IFC, who is sitting in for Issa Fay, who unfortunately had a family emergency, but we're thrilled to have Luyen with us today. So thanks to all our panelists for being here, and I'd like to kick off our discussion with a question to you, Pete, to start off. Pete, Nuveen is a longstanding leader in the impact investing market and has a multi-asset portfolio that has been verified by BlueMark more than once. Would love if you would share, Pete, how Nuveen's impact management practices have evolved over the years and sort of what you've learned through the process and what challenges remain.
Yeah, sounds great. And thank you so much to the BlueMark team for having us. We're so excited to be a practice leader on the board this year. For those who don't know, Nuveen is a relatively large asset manager based in the US. We're the asset management arm of TIAA, which is one of the retirement service providers for teachers and nonprofit employees. And we've been active in impact investing for a number of years, about a decade now. We do have, as Christina mentioned, about $5 billion in impact assets under management across public fixed income, private affordable housing, and private equity impact investing. And I believe all three of those strategies have gone through 2 BlueMark verifications for our impact management process. I sit on our private equity team, and that's the sort of group that's been named to the leaderboard this year. So I think, how have our practices evolved over the course of the last decade? I think, when we started, we were one of the only large institutional investors making impact investments. And really the avenue for us to do that was by investing into funds. And so at the outset, we were an LP. We were focused on ensuring that all of our investments met basic ESG thresholds, and that our managers were collecting and reporting on impact information in as consistent a way as possible at the time. We've evolved as a manager. We are now more of a GP. We've raised third-party capital, closed our first third-party fund last year. And in the course of that decade, I think a number of developments have sort of influenced our practice to where we are today. but I'd probably highlight 3 of them. As is highlighted in the report, we have sort of 2 key themes for our impact practice, and those are inclusive growth and resource efficiency. We were initially looking at those as separate. So trying to identify companies that had products and services that were sort of benefiting low-income consumers around the world, and also trying to find companies that were mitigating climate change through their core product or service offering. What we found over the course of the last 5 years or so is that we really need to think about both of those things cohesively. And so our sort of strategic impact intent has really focused on ensuring that we are sort of guiding towards an equitable transition to a low carbon economy. So in our investments where there's a sort of core product or service that's benefiting climate, how can we ensure that those are accessible to low income consumers? And in our investments where we're providing basic services to low income consumers, how can we ensure that those products and services are really building resilience to the physical and transition impacts of climate change? So that's the first key development, is really sort of the focus and the sort of narrowing of our impact thesis over time. I would say along with that, we've also really evolved our approach to engaging with our portfolio companies. So I think whereas at the outset we were focused on minimum thresholds being met on the ESG side and driving sort of long-term performance through impact reporting, we're really now looking at how can we actually engage with our companies in a value additive way to help them better understand their social and environmental performance, both pre and post investment, and then sort of drive those outcomes long term. We are growth equity investors, but we're minority investors, typically taking significant minority stakes. And so we don't have the leverage or sort of control that our control PE peers do. And so we really need to think about how can we use our influence as shareholders and often as board members most effectively in driving sort of climate change and inclusive growth oriented outcomes. And we've developed a pretty comprehensive approach to that over the course of the last decade, which we're continuing to test and refine. And then I would say the third sort of development over time is really we try and focus on benchmarking both our practice and our performance against the broader market. So on the practice side, I'm talking about what we do, how we engage with companies, how we think about the impacts that we're trying to achieve, really everything actually that's assessed in the BlueMark assessment and in the operating principles for impact management as well. And I think one of the sort of key developments in the market over the course of the last decade has been that there are now external verifiers like BlueMark who can do this for us. As I mentioned, we did this 2 years ago with BlueMark, and then again a couple months ago. We learned a lot from the first verification, improved our practices. In fact, I think in the 2 areas that Tristan highlighted where the broader market improved, we did as well. And so that type of practice verification has been super useful. I think on the performance side, we're also really interested in how do we collect the right impact performance information so that we can compare our performance credibly to other impact managers in the market. And this is an area where I think we're not quite as far along as maybe we are on the practice side, but there's been some really promising developments in this. And I'll call out the GINS Impact Performance Benchmark, which was released earlier this year as sort of an early step in that space. In terms of where we have left to go, I won't go far from that last item there. I think there's a lot more that we can do to collect comparable impact performance data and compare. And I think that'll be useful both to our LPs to understand which of their managers are generating the best long-term social and environmental results, but also to us as managers to understand where we can improve and what practices maybe are leading to the best performance. So anyway, I'll stop there and pass it back to Christina.
Thanks so much, Pete. That was a very rich set of insights and learnings. Look forward to returning to some of those themes. So Pia, I'll turn to you next. You're representing Trill Impact, which is a relative newcomer to the field, and as such had to build its impact management system from scratch. Would love to hear sort of how you went about designing the system and what standards and tools were most useful and relevant as you did so.
Sure. Thank you, Christina, and thank you also for hosting this session and also appreciating that we are on the short list. So Trill Impact was founded in 2019. We are already a multiple strategy impact house with private equity buyout, microfinance, and even a venture strategy. We are focusing across all 17 SDGs under the theme of sustainable planet, healthy people and resilient society. And under that, 3 topics we have made all together, including add-ons, 18 investments so far. So to your question, I think actually what's very helpful, starting with the blank sheet of paper, when we designed our strategy, we all come together with the founder, Jan Ståhlberg, having a mission of creating this kind of multiple strategy impact house. So I will walk you through 5 different, I would say, critical success factors for us to actually come to where we are today. First of all, I think the most important is the team, that everyone recruited from both mainstream and more specifically impact or ESG roles came together with a mission to deliver, accelerate value creating impact. And we also initially started with a partnership together with Nordea, where we had dedicated resources to help us with impact analysis and ESG analysis from start. So the team was really essential, and that was, of course, very important part of the interview process. Secondly, I would say that we embedded impact in every process. So from sourcing to investment process, the different steps, the material, also having me as an impact partner, as a voting member on the investment advisory committee, as well as through the active ownership approach, how we partner with potential portfolio companies before signing to make sure that we have an aligned interest of where we would like to take the company. And then, of course, active ownership and active support, both in terms of reporting, but also integrating what we call a value creating impact plan in every company, and also considering that at also exit. The third one is that we actually approach impact in the same way as we approach financials. So me coming with a financial background, but always a foot in the ESG area, I wanted to have an EBITDA bridge described in a similar way as impact. How can we talk about the starting point? What are the building blocks in order to accelerate impact? And how can we describe that in a quantitative way? We used the impact management project, but we also created our own rating model on top of that in order to actually be more precise in our internal discussion, but also with our investors. So having that as a base, and of course using the operating principle for impact management has been also very useful when designing the different processes. I would say, fourthly, we have thought about it from an incentive perspective. When we design the KPIs for our portfolio companies, which we actually do as a part of our investment process, we have indicative impact targets and also ESG targets. We think about it and discuss it with management in order to actually integrate that in their incentive streams. So part of the bonus is from day one linked to this. We also have it part of our credit revolver, which is linked to the science-based target and the achievement for every single portfolio company. And we also have it as part of our LBO financing, and that's more unique than to each company. So it's really a covenant in itself, in the same way that we have financial covenants. We also have it part of the Trill Impact carry model. And fifth, I would say that we decided early that this is a journey. We would like to get up and running fast, and we also wanted to have it verified, and that's how we engaged with BlueMark in order to understand where we are. I think initially it was a very a good way to think that we need to have our house in order, but also we were very curious to understand how far we're taking our approach and building it in the what we believe was a robust way. And I think that's also a very important thing going forward. This area is evolving rapidly, both in terms of the maturity in what leadership in portfolio companies actually can deliver on and engage in, but also, of course, from a regulatory perspective. So I think having someone looking at our processes from external is very important for continuous improvement and challenge and find the weaknesses, but also to share best practice as we're doing here today and learning from others. I think that's key for continuous involving, and back to the team, that's also inspirational for the team. Like if you're recruited a good bunch of people, you really want them to be inspired to continue to involve on the personal and the firm side.
Great. Thank you so much, Pia. And there was a lot packed into that description. I imagine the audience will be interested to return to the question of linking financial incentives to impact achievement, which you've really embedded in your strategy. So hopefully we'll get back to that in the discussion. I'll turn to Daniel next. And Daniel, you represent, again, one of Brazil's only pure play impact managers in the market, a smaller manager than some of the others represented here, and one with quite advanced practices. How have you evolved Vox's practices, and what are the challenges that you face in perhaps keeping up with larger peers when it comes to achieving best practice?
Perfect. Well, thank you very much, Christina and BlueMark team, for the invitation to take part in this webinar. It's an honor to share this table with such an amazing group of peers. I'm already learning a lot with Pete and Pia. And at Vox Capital, we had our impact system recently verified by BlueMark, and I must say that's helping a lot us to shape our impact strategy and to move forward with it. As Christina mentioned, we are the first Brazilian impact asset manager in Brazil, and most of our assets are under venture capital funds, are under VC funds. And now we are on the course of moving forward and working with other asset classes other than VC funds, which I may comment briefly in my answer to your question, Christina. I think it's easier to understand how our impact management strategy evolved, framing it in two generations or phase of impact management that we've been facing here at Vox Capital. Our first generation of impact management was totally oriented to our VC funds. And as a VC fund, we were basically investing in startups. So the major assumption that we had during these first generations stated something like that to each development stage of the startup, a specific impact management approach was required. And when I'm saying about stage of development of a startup, we have a simple frame for that. Just saying about early stage startups, growth stage, and scale up in this order, okay? In practical terms, it means that our impact management technology and tools would differ considering the stage of the company, okay? And actually, we worked with building blocks, which means that in kind of a cumulative way. So when we move up on the scale of development of the startup, we add other and more complex tools on the top of the existing ones. So, we do believe this was a very respectful approach with the companies that we were investing in, because it takes into consideration the stage they were living in. For example, I could say that I could go into an early stage startup with a fear of change, but it wouldn't be feasible to go into the same startup, the same early stage startup, asking them to provide me an outcome-based external evaluation. They weren't even ready for that, okay? So this inner principle is to balance the stage of the startup and the approach, the technology, our IMN technology. to understand the impact they were delivering, if any, okay? This is, we believe it's fair and feasible, okay? And when we move forward to our second generation, which is our current generation, our current impact management generation, that is distinguished from the first generation because now we have to cover other financial classes other than VC funds, because we do have in our strategy the first Brazilian asset manager, impact asset manager. So as a pioneer of the ecosystem here, we do have this sense of responsibility or this duty that we should bring impact investing to retail, okay? Yeah, we do have venture capital asset class, but it's not affordable for most of the people. So we need other asset classes than just VC funds. And we are currently designing, we recently launched our first fund to the retail that is a fixed income fund oriented by the SDGs. So it brings new challenge to the table because I have a new asset class to define how I'm going to manage it, how I'm going to do the impact manage that. So what we realize in this current generation is that the basic assumption that we have is not enough anymore, to allow us to a strong and to a robust impact management of our new funds. So we added another assumption to our IMN approach, to our impact management approach. And these new assumptions say something like that the more effort from the investors or the more investor contributions, more impact management robustness is required. In practical terms, it means that we will go deeper in our impact management approach in those investments in which we are more engaged as investors. So I'm bringing here into these assumptions the principle 3 of the operating principles, that states about the investors' contributions. And to measure these investors' contributions, as Pia was mentioning, the impact management project, we use the impact classes scale from the impact management projects that rank from 1 to 6 regarding the investors' contributions. So we are adding this new axis, if I can say that, to our frame. So we have the original axis considering the stage of development. Now we are adding another assumptions considering the investors' contributions to frame our impact management approach, okay? And we come up with this new framework that make this clear correlation among investors' contributions and impact management guidelines. It follows the same idea as the first generations to be in a cumulative order, which means that when I move up on the scale, I add more IM complexes into this game, I'm just putting above the techniques that I already have. For instance, this fixed income fund that I just mentioned, we label it as a B1, okay, considering the impact classes. So just looking at the investors' contributions, here we are at the lowest grade of the rank. It's a 1, sign of that impact matters, that's all. Okay, so here to this kind of investment, so to this kind of asset class, we really go soft on our impact management approach because it's a 1. We don't make that much effort, to work on that. But when we move up to our VC funds, they are labeled as a C4. Sorry if maybe it's too technical, but it's important to say that, okay? And it matters that it's a 4. So it's much stronger. We are bringing much more contribution into that investment. So to that kind of investment, really deep dive into our impact management strategy. We don't have yet any investment considering the ranks 5 or 6 because it's flexible capital, but we may have in a few years.
Got it.
That's it. Maybe
Thank you so much, Daniel. I think your comments really, I think, help folks understand the need for adaptation of core standards and principles to different different investment contexts and different asset classes. So I really appreciate those points. I'm going to turn now to Luyen Tran, and clearly the IFC sits in a fairly unique position in the market. Well, number one, as the secretariat of the impact principles, but as an entity with a very long history of impact investing and development impact. It would be interesting to hear, Luyen, how the IFC itself as an investor incorporates sort of evaluation of the quality of impact management into its screening and evaluation of its prospective investees and manager, and to what extent you see a role for impact verification in that process.
Great. Thanks, Christina, and thanks, colleagues, for letting me come in at the last minute. East Sense's regards and regrets, obviously, for not being able to make it. But we didn't want to miss this opportunity to come in and join your panelists to talk about what we think is a relatively important idea in impact investing, which is this idea that we have a collective issue that we want to attend with, which is, how serious are we all as when we assert that we are impact investors. IFC, for those who may not be aware, we're the private sector arm of the World Bank. We manage about $86 billion worth of assets that we view are aligned with impact principles, an organization or an entity that we helped initially establish. I should note, Christina, that even though we help manage the secretariat to the principles, it is technically a separate entity from IFC. It does have a useful function in the marketplace, not least of which is to help our membership certify and align their practices to the principles. IFC did help start that business, or this idea of having signatories to impact principles themselves, which we think is an important element to helping improve the standards to promote impact investing in the industry. Like I mentioned, we've been doing this for about almost 7 decades now. And from that experience, we think that we would like to see a lot more impact investors out there. And hopefully with the activities like this, helping to help shore up these what we think to be our credible impact investing management strategies, we're going to be able to kind of get an industry that is credible and that is going to deliver the outcomes. Now, even though we're separate from the Secretariat of Impact Principles, there are some common approaches, I think, that all of the signatories to the Impact Principles are espoused. And that is the voluntary publication of these disclosure statements. And so when we think about the credibility of impact investors, that the mere act of actually going out and saying, we are dedicated to this business, we are serious about what we are doing, and we're willing to sign on to fellow practitioners and certify every year that we abide by these, or we are aligned, our assets are aligned with these types of best practices. I think the mere act of doing that sends a very powerful signal. Pia and Pete are part of that membership. Great to have you here. Welcome that, and we hope to have as many others join us as well, because that membership helps promote a collective effort to try to improve all of our standards. So in terms of the role that the impact principles play in trying to promote this industry, I think helping promote investments that are focused on impact and have a seriousness of purpose, I think, is quite consequential to that. With respect to the question about external assurance, it's part of the process. So Principle 9 of the signatory of the impact principles requires that when we issue as a signatory to the impact principles, when we issue these statements of alignment with the principles, we have it externally assured. So it's absolutely important, absolutely essential to that. Let me bring out a point that Pia made, which is that she comes from a financial background, as do I think as most of us, and we give a lot of seriousness to the underwriting, the investment underwriting process. And the question for impact investors is, are we ready to give that level of seriousness and commitment to the impact side? And doing things like signing on to these principles and having them externally assured every year or periodically demonstrates and reinforces that seriousness of purpose. Another element, and I'll stop after this, is this idea of aligning your strategy and aligning your approaches to that. So at IFC, one of the things that we do, in addition to assessing our investment projects for impact, and it's in addition to managing the risks with respect to ESG constraints, in addition to monitoring our investments and identifying the contribution, we very much align our payments, our staff incentives to the delivery of impact. So every year, when we think about how we distribute our bonuses to our investment staff, I get a call from our human resources office, and they ask me, can you give me the list of all the scores that you've assigned to these investment projects that's going to be featured in our assessment of whether or not we provide some staff incentive payments to these projects that are being proposed for staff awards. So it's building that and integrating it into the work of these organizations is quite important, quite consequential to the credibility of the industry. So I think the view from us is that when you have the seriousness of purpose of being an impact investor, and you're dedicated to that, and you want to help promote the improvement in the industries in terms of the standards, then a natural growth in that would be just to voluntarily say, I'm ready to be counted. I'm ready to submit some transparency to the work that I do, and I'm ready to have a third party assure the work that I'm dedicated to. And that, I think, says a lot about the power of these entities like the impact principles, the power of the work that BlueMark is doing, and to try to help promote the assurance verification process along the way. Let me stop there. Back to you, Christina.
Great. Thank you so much, Leigh, really appreciate those comments. Another representation of the importance of aligning incentives with the achievement of impact, which is a growing practice, but still a minority practice as far as our findings are concerned. I'd like to turn to a question that is another sort of hot topic in the market. In fact, it's come up just now in our Q&A, and that is the question of stakeholder engagement. I think there's growing awareness in the field of impact investing of the importance of identifying the affected stakeholders and engaging and representing their voice in the investment strategy and the impact management process. It's not explicitly a part of the impact principles, but it is definitely increasingly a practice being emphasized by other complementary practice standards, and we believe starting to enter the mainstream of impact management. As Tristan had pointed out, still less than a third of our sample address the issue in some way, but it's obviously a critical one. So given that you all represent leading, impact management practitioners working in a variety of contexts, I'd love to hear you each, in really, if you can keep it relatively short so we can reserve the time for additional Q&A, just a bit of a comment on how you think about engaging the stakeholder perspective in your impact management approach. Why don't I start with you, Pia?
Yes, sure, absolutely. I think in Europe, we have the EU taxonomy and SFDR new regulations. And I think actually that is bringing in our case, the LPs and GPs together, that instead of having a debate or discussion on what to report, we're actually standing on the same side and say, like, how can we help each other? And often things start with how can we measure things? How can we measure progress? How do we look at that? And I think that in our case, we have a lot of meetings with investors to actually discuss and elaborate and benchmark and how we can help our investors and how they can help us. I think that's a really good dialogue. We also, if we take it further, engage. I think the stakeholder engagement should not only be with our investors, but we also need to help our portfolio companies. So we actually are actively helping our companies with the program to design, develop their sustainability reports, where stakeholder engagement is a really important part. And we can also connect our portfolio companies with our investors, which I think is very helpful. So having a clear purpose, and sometimes actually the regulations help to be very constructive in the dialogue, rather than not understanding exactly and being explicit on what to discuss.
Great, thank you, Pia. Pete, can you in on this question as well?
For sure, and I'll try and keep it brief. But when we think about stakeholder voice, we're really focused on trying to understand how the eventual beneficiary or the sort of target beneficiary of our investments is experiencing the outcomes that we hope they experience. And maybe just 2 quick points I'll make on this. We go through this in sort of a variety of ways, surveys. Sometimes we engage external consultants to help us. Sometimes we work directly with companies. But 2 points, I think, one, we firmly believe that this needs to start pre-investment. Understanding the individual that you are trying to impact and sort of the needs of that individual is an essential part of underwriting an impact thesis for a company, we believe, and selecting appropriate metrics to measure the long-term social and environmental performance of that company. The other point I would make is that, I think there's a lot of focus on, when people say stakeholder voice, they think client voice, but there are a number of other stakeholders of a business, as Pia pointed out, and in particular, we're really focused on worker voice for a lot of the companies that we're invested in, particularly ones that have large, hourly or, large workforces, where obviously the sort of perspective of that individual worker is incredibly valuable feedback for the performance of the business, but it's also another stakeholder that we're trying to impact positively through our investment. And so understanding their experience of working at this company is really essential for us. So I'll stop there, just in the interest of time.
Great. Lillian, maybe I'll go back to you again on this. The IFC has 7 decades of experience with stakeholder engagement. What would you add?
Yeah, not much to add beyond what Pete and Pia had mentioned, except to say that our impact rating system is based on the stakeholder framework. So it's at its core is an assessment of what the effects are on the stakeholders, the economy, the environment in which these investments operate. A point that Pete made is quite consequential here, and that is the difference between the client as stakeholder and the entities around the client. At IFC and other multilateral development finance institutions, we have this separate idea of it called additionality. And so additionality to us is what we bring to the client. Impact is what we bring to the stakeholders, and that goes beyond the client. And so in many ways, the way we think about it is that we work through clients to have our impact. When we think about impact, we think less about what benefits we bring to the client. We think about the effects on the environment, the society, the markets in which that client operates. And then a separate idea of additionality is what we bring to the client, the financing that the client may not otherwise get because of some other reason or some other fact. That for us, it's basically in emerging markets and developing countries. And that stakeholder framework is important, and getting that voice is quite consequential. And like Pete and Pia, we have surveys, and a lot of times our advisory services that we bring coincident with our investment projects is oftentimes the primary deliverer of impact. And having that connection to the ultimate beneficiary, which is the stakeholders, is quite important for our assessment of impact. I'll stop there.
Great. Well, I'm looking at the clock, and Daniel, I'd actually like to transition. There's a couple of questions in the Q&A that were directed at you, if you don't mind. And one of them I think is a really pertinent one. It's you use the term flexible capital and identifying in certain cases the need to bring flexible capital to the table. I'll just point out that in our Making the Mark report, we found in our sample set that those investors who are wielding what they refer to as below market flexible capital generally, or at least on average, performed better than their market rate peers. And when it comes to impact management practice, perhaps not surprising at an average level. But Daniel, perhaps you can talk a little bit about, where you see the greatest need for flexible capital and what exactly that means to you.
Yes, sure, thanks. Well, I should take care with these questions because when I mentioned flexible capital, I was meaning that when you look at the investor contributions rank and you have the grades 5 and 6, there, now you cross the hurdle for flexible capital. In Vox Capital portfolio, we don't have yet any asset class that is located in one of the size of the rank. So we don't really have yet any asset class under flexible capital. I've been following some of this experience here in Brazil, especially with venture philanthropy, with blended finance, and I totally agree that you really can reach very deep impact with this kind of approach. But what I could add is that even we don't have flexible capital, what we do have, and this connect with your previous questions, is that we provide non-financial capital. So in order to help some of our stakeholders, like the entrepreneurs, to engage with impact management and to gather data and to learn with this data, we provide a lot of non-financial resources, such as facilitating fear of changes, capabilities, different kinds of non-financial resources, and this improve their capacity to really understand the impact they are achieving, if any.
Great. Great. Thank you, Daniel. I'd like to turn to another question from the audience, and this one is a fairly broad one around impact integration, and at what stage in the investment process does impact integration matter the most? I guess if somebody was getting started, what would you emphasize first? Is it the design, the implementation, or the execution phase in the investment process where, sort of a rigor around impact management and integration matter most? Why don't I turn to you, Pia, first, and I may ask a couple of others in here.
So if I would have to choose, and if I had a firm before that was like transitioning to become more impactful and impact oriented, I would start with execution, because I think that is, of course, where you can make most impact in the companies and driving change in companies. So focus on that, and I think that also would drive the excitement with a firm, and also actually drive the processes to improve. And I would say that's also where I'm come from an investment perspective, that when you start to engage with the management team and sort out how the company can grow and position themselves and do good, it is very much appreciated by the CEO and the rest of the management team to understand how they can create a story of the good that they will deliver to their customers, and also how they engage with their employees, and how do they become a more attractive employee. So I would start with the execution, but of course it makes so much more sense if everything goes hand in hand, and you will not be able to, in the long run, execute successfully with impact if you don't have it throughout your system. But if you need to choose where to start, I would start there.
Great. Pete, I'd love to hear your perspective on this question, given you all have been through the verification process twice. Maybe your view has evolved on where it's most important.
Yeah, I mean, I think I would definitely agree with Pia that sort of alignment with the companies you are investing into is sort of the most essential of all. That in our experience has led to best long-term social and environmental performance. I guess I would also say that a really clear strategic intent for a first-time impact fund manager is important. I think it can be just really challenging to underwrite any deal if you don't know exactly what you're looking for from an impact perspective. And I think most general GPs who are managing other people's capital know what they're talking about from a sort of financial perspective. But often we see GPs who come to market with a really broad impact strategy. And I think the intent there is not to sort of narrow the universe too much, but it often manifests in a lack of clarity around what they're actually looking for, and that can actually make things more challenging than the sort of constraint of a more clear and codified strategy at the outset. So I'd say starting with that strategic intent is also really important.
I just want to sort of back up that comment, Pete. One of our key learnings ourselves at BlueMark from evaluating so many systems was just how important it is to be crystal clear and rigorous about the evidence base associated with the theory of change and logic models, so that you can translate your thesis and intentions into a really clear kind of strategy throughout the investment process. So we ourselves tightened up our criteria a bit and found fewer folks meeting the advanced bar than we did last year around. Any other comments on this particular question, Loyan?
Yeah, so I take a little bit of a different view, and mainly because, so for me, so if you want to make impact as part of your strategy, it's going to have to be part of your decision-making process. And for that, impact integration has to come in at the design stage. An example I often give is that if you were expected to go on Shark Tank, and you're asked to have a view about the financials or what your exit strategy is, and you haven't figured out by the time you make a pitch to the sharks, then Mark Cuban's going to laugh you out of the room and just going to make you go home. Would you ever go down the road making a decision if you haven't considered the financials of a firm at the design stage? And the question for impact investors is that, are you serious? Like, are you serious about the work that you're doing? If you are, maybe you have to think about what impact you want to create or what impact you want to generate at the get-go. And for us, that's a very important part of the discipline that we're trying to promote at IFC, that we think very early on exactly the stakeholders that we want to affect, the people that we want to change, the livelihoods that we want to improve, and then help design a way to get there and figure out all along the decision-making process. Thanks.
Great. Thank you, Lane. Really, I see some.
Can
comments.
I add something, Christina?
Sure, Daniel. If you can keep it short, because I want to move to one last question. We're going to run out of time.
Okay, really short. Yeah, we also do believe that you must look at the impact from the outset. And when we're seeking companies, we are looking for impact companies. But we learned that we have to help them to understand their own impact. So we are facilitating theory of change before the deal. We are making impact interview before the deal. We are making tough questions before the deal, because sometimes you just have a sense of impact. And if you, as an investor, contribute then to better understand deeply the impact, they have the potential impact that they can achieve, I think it's something that it's worth doing.
Okay, great. Thank you. That was a useful addition to the conversation. It looks like we're weighted towards sort of the ex-ante stages where it really, really matters how you articulate and diligence for impact. I'd like to finish up. We only have a couple of minutes, and it's such a rich conversation, impossible to capture everything. At BlueMark, we view sort of the next frontier beyond disciplined impact management practice for the market as being best practice around impact performance and the reporting of impact results. And I'd love to hear, just a few words perhaps from you all about what you see as the future prospects for moving from practice and expanding our lens to best practice impact performance reporting. What do we need to happen in the market for the market to align around standards on that front? I'll start with you, Loyan, because I know this is a close topic to your heart.
Yeah, so I can't say enough, and it can't compliment the work that BlueMark has been doing on this space. And it's actually, we look to BlueMark in many cases to think about our own impact reporting. So the challenge for us is, how do we do that better? How to connect the data that we're collecting to the lives of the people we're trying to improve, and that's very hard business. And so over the last few months, we've been trying to develop an impact report for IFC that combines a lot of these elements. The data that we collect, the discipline that we go through in trying to articulate what is good impact, what is not so good impact, and then being able to connect that with the individuals that whose lives we're trying to improve. And it is a very tough business. I mean, I can have a whole separate conversation on this, but I think that the benchmarks that we want to focus on is, what are the results? How did it compare against what we originally established? And in many ways, what are the lessons that we learned, both from the successes and the failures? In many respects, the failures that we have experienced are just as important in helping us promote impact as the successes that we generate. Stop there.
Great. Thank you, Leanne. And I unintendedly will let Leanne have that last word from the panel. Apologies there, but we're out of time. I just want to thank you all for your incredible leadership in this market, the thoughtfulness with which you're approaching your impact management practice, and how you're setting the bar for the rest of the market. So collectively, all of you, thank you so much for participating, and Look forward to seeing you again next year for the 4th annual Making the Mark report. Have a good day, everyone.
Thanks, everyone.
Thanks so much.
Thank you so much.
Everyone. Thanks.
Bye-bye.